investing in property makes sense, investing in the right property takes knowledge. Welcome to the Rewarding Property Decisions podcast. I'm Jared McCabe, Director of Wakeland Property Advisory. Join me for expert insights into the fundamentals, trends and opportunities to help you create long-term wealth through smart property decisions. Hi everyone, and welcome to episode 23 of the Rewarding Property Decisions podcast. So we started the year discussing our annual property report, and last week we looked at a survey that we'd conducted and the results that showed, looking at things like the confidence levels that are currently in place for property buyers around Melbourne, and how that will impact the market going forward, and obviously how it impacts market sentiment at any particular time. So the second part today that we'll look at of the property report is to discuss the year ahead and the market dynamics for 2022 and how they'll likely shape and impact the property market going forward. So things that we'll be looking at are interest rate rises and obviously the opportunities and threats that they can pose, rebound of the rental market and the importance of maximising rental returns, and then obviously the housing affordability, which has been quite topical as well given the price rises that we've seen through 2021. So if we look first at interest rate movements now, interest rates are always a hot topic no matter what's going on. And given the record lows that we've been experiencing for some time now, there's always been a lot of talk around could we even drop below zero, such as countries like Japan and Switzerland have experienced for extended periods of time. However, the talk changed around the time that Melbourne came out of a lockdown in September last year. The Reserve Bank started to signal that it may start to look at lifting rates, and buyers as a whole who've certainly become accustomed to the record low rates that we currently experience and the suggestion horrified that rates may rise meant that a lot of buyers needed to review their plans, and this should form part of any property buyer's due diligence that they're doing at any particular time, reviewing rates, making sure that you've got any fat built in, or you do have some fat built in to your numbers, just so that if there is a rise, it doesn't put you on the edge. So that's something that we've talked about for an extended period of time. We always mention that, and it's something that any buyer should consider. But if we look back, say, at just to look at opportunities that this can present when there is talk of downturns and markets changing, if we go back to, say, 2017 to 19, there was talk at that point in time that the market then was suffering the biggest downturn since the 1980s. So someone who'd purchased, say, in 2017, and what might have been at that stage considered the peak, they were certainly starting to probably become a little concerned. And then that was exacerbated further during the drop in values in 2018, where values came back as much as 9%. So obviously people at that point in time would be feeling quite nervous and worried, have they made the right decisions? But then if you look at what happened in the second half of 2019, where that almost 9% drop had occurred, prices recovered that and some through the second half of 2019, and then obviously the record-setting prices that we've experienced through 2020 into 2021. Anyone who bought back in 2017 is now very happy that they did so, even though at the time it was looking quite worrying. I guess that's part of what we're looking at the moment, in that the market is potentially looking like it might go through a bit of a plateau over the next 12 months or so. So should we buy? But bearing in mind, and we'll reiterate this all the way through today, as we always do, that buying property is very much a long-term exercise. It's not something that should be done with the short term in mind. But it is important that you do protect yourself from interest rate rises, because eventually they will come. We can't expect to see the record low rates continue as they have been. Obviously, they've led to increased competition, and that's what's really driven prices up in recent times. But we have seen strong signs that later this year there will be an increase in some form. But the attempted cooling will also come from other factors as well, such as tightening of APRA lending criteria. And we've seen that before. Again, back in 2018, APRA was influencing lending regulations due to the Royal Commission. But this time around, it started back in October when the minimum interest rate buffer to meet lending requirements was increased from 2.5% to 3%. So that's just another way that the control of money flow can be impacted by other factors other than just interest rates, and that certainly has a flow-on effect to the property market as well. So as we said, you do need to take all of this into account when you're doing your budgeting considerations and making decisions around buying property. Now, the other thing to remember is that any interest rate rise that does occur, it's likely to be gradual. It's not likely to be a significant jump overnight. The idea from the Reserve Bank's perspective is not to create financial distress. It's to give a gradual rise to try and slow things down. And this will allow, from a property perspective, investors to cover off movements with things such as potential rental increases, maybe selling other assets if that's what's necessary, perhaps tightening budgets, and reining in lifestyle expenses. And all these things can help to offset any interest rate rise that does occur. But one of the other things that could help to counter the increasing interest rates is a resurgent rental market. And so if we look at what's happening in that rebounding market at the moment, asking rents, for instance, in the inner city apartment market are certainly starting to rise. And this follows a stretch of obviously modest performance during the COVID pandemic. Apartments in areas like South Bank and Docklands, which have consistently been oversupplied markets for an extended period of time, they're showing and giving plenty of choice to renters, have shown 3.8 and 3.7% rises respectively during the December quarter, according to CoreLogic. So the major driver for the slump that we've experienced in that sector over the past 2 years during the pandemic has particularly been to do with a lack of international students and obviously travellers who've been seeking housing. And that means that without them coming in due to the border closures, there's not that same take-up of demand for that type of property. And Melbourne particularly has a significant exposure to overseas migration and therefore did really suffer the brunt from a rental point of view of these restrictions. In October, Melbourne became Australia's second most affordable rental market at around a median of around $450 a week. Now, with Australia now starting to open up, the rental demand is likely to increase, and with the influx of international students and workers coming back in. And that'll be combined with the fact that domestic factors are also starting to show promising signs, with renters seeking more affordable accommodation and being a bit more flexible and happy to move around given that restrictions are less onerous at the moment. Now, it's important if we look at the next heading that we wanted to cover off on, which is maximising your rental returns. Now, a buoyant rental market certainly benefits investors due to those increased returns, but it's particularly relevant and important if interest rates are again on the rise. The next topic that I wanted to cover off on is maximising rental returns. Now, it's important in a buoyant rental market that we understand, obviously, that increase in prices is going to benefit investors due to that increase in return. But it's even more important when we start to consider that there may well be some interest rate rises in the near future. So if we look at different sectors of the market, the area that's borne the brunt of the COVID lockdowns has certainly been the inner city apartments, and they've suffered the greatest reduction in values. The recovery, however, will certainly flow onto other areas that have been impacted, so impact the broader rental market. And the particularly relevant sector is obviously the older style apartment market, which do make up a large amount of Melbourne property investor portfolios. But it is important with these types of properties that they are maintained and kept up with modern amenities, because otherwise they won't keep up with those high-rise type developments which have been more recently constructed. So if you've had a property, and there has been many that have been vacant for extended periods during the pandemic, it's been really important to try and upgrade those properties. And a lot of people have taken advantage of vacant periods where they can try and increase the quality of the amenities. So whether that's air conditioners or paint, carpet, upgrading kitchens and bathrooms as appropriate, but certainly trying to get in there and improve the property. And what that does is obviously increase the potential for rental return, but it also increases the quality of renter that you will attract to that property. And this is particularly relevant for rental providers who've been fortunate enough to have renters stay long-term in properties. But what obviously that does is gives you a far less vacancy period, but it also means that there's less opportunity to maintain and upgrade the property. So when the property does become vacant after perhaps a 5-10 year period, there may well be increased costs that need to be attended to in order to bring it up to what would be an acceptable standard in the current market. The final sector that I wanted to talk about around impacting market dynamics going into 2022 is obviously housing affordability. Now, certainly the surging prices that we experienced during 2020 and 21 benefited those currently holding property. It continued to increase their wealth and equity in their properties. But it did cause obviously significant issues for those who are trying to break into the market. Many of them are hoping that the forecast downturn with increasing interest rates might mean that prices will start to reduce. I don't see that being the case for 2022. I think there will be a plateau, but I'm not expecting it to result in prices going backwards. It should, however, create a few more favourable conditions. There should be less buyers around competing with one another. But the other thing is that there'll be less significant price jumps, leaving many buyers feeling that the market is running away from them. And that can quite often be an issue when the market is jumping like it was last year, that people just get downcast and really shattered that they don't see where it's going to give them an opportunity to actually break into the market. In the last 10 months leading up to October last year, the cost of delaying buying was significant. For a typical house, it was as much as $600 per day was the cost of delaying, and for an apartment, it was $150 per day. That's according to Peter Martin, who's a visiting fellow from Crawford School of Public Policy. The median house price, well, that pushed ever closer to the $1 million mark for Melbourne, which it will inevitably reach, but it's currently sitting as at October around $960,000. Household spending, well, that's currently at an average of 32.1% of income on the mortgage, which is a significant increase from February last year when it was at around 29.7%. It's not really overly surprising, though, given that the typical home surged as much as 20%. And during the same period, the typical wage rose only 1.7%. So that gap is clearly why it continues to widen. But the sharp rise was certainly clearly driven by a number of factors, which we've obviously spoken about: the record low mortgage rates, significant lift in household saving, and the range of government stimulus, and obviously the improving consumer sentiment. Now, the benefit for buyers going into next year who are concerned about the affordability is that many of these factors are likely to either be removed or scaled back. So that will also hopefully help for the lack of competition, or pull back some competition, and make the affordability a little bit more possible. So if we look forward for 2022 and beyond, certainly the predicted interest rate rises will have buyers and investors reevaluating their position and most likely reducing a level of competition that's been around for the past 18 months or so. There'll be other uncertainties that will create, that people will be considering, things like the potential new COVID strains that will inevitably come forward. Obviously, we've got a federal and a state election this year, which typically when the property market makes both buyers and vendors sit on their hands leading into that. So we will have two of those, which again will most likely pull the market back a little bit. And there'll be the ending of a number of government stimulus packages which have been introduced. So during these times of uncertainty, they can derail the best laid plans. So it's really important to remember that you've made those plans. Make sure they factor in any of these potential changes, whether they be the interest rate rises that we've talked about, so that you've still got confidence in them. You can have a long-term forecast and a long-term outlook for property, which is what we always talk about, and it will give you confidence to get into the market when the time is right for you. That's about it for today. Thanks for joining me for episode 23 of the Rewarding Property Decisions podcast. Please feel free to share the podcast with friends, family, colleagues, and anyone that you know that may have an interest in property. If you would like further information on how to make rewarding property decisions, please feel free to visit our website, wakeland.com.au, and we wish you all the best with your property decisions.